Okay, welcome back to the second session, guys. So I've had a question regarding the recordings. So the recordings I will load onto a YouTube channel for you guys, and I will make the link available on VC Learn. So then what you can do is you can just go to the channel and then go look at the specific recordings you want to look at, and then just download them if you want to. Okay, so some of you mentioned that you have not received your textbooks as yet. Okay, so what I want you to do in the interim for now is please just make a few notes on the key concepts. So we're going to discuss these key concepts. Now, these are basic things you need to understand before we can even go on to building the accounting equation and all the other elements. Now, if students don't understand what these different documents are or different accounting sources, what happens later on when we get to the other learning units? What I've seen in the test and the exam is students get confused what is asked because of the fact that they don't understand what is the difference between these different types of accounting sources. So that's why I want to spend a little bit of time on this today. And then for the guys, once you get your textbooks, this is where you can find it on page 22 to 23 in your textbooks. Alternatively, if you have not received the textbook as yet, what I would suggest is there is a copy in the library, either to go make a copy of the relevant items there when you do the homework, or just sit in the library and just go through the work so that you at least know what we are talking about in the interim until you get your textbook. Okay, so let's start with source document. Now, source document, when we talked about it, it can either be a paper-based or electronic record. Now, that is, for example, your till slip would have been paper-based. But nowadays, you can also receive an invoice, for example, online. So someone will email it to me, which is then an electronic version of it. And we use that document to transcribe. So it's basically record. So we take the information that's on that document and we record it into and summarize it into the business financial transactions. Okay, so let's take an example. For example, your till slips. You would have used that receipt to record the cash that you've received for that day into your cash register, and we would have shown the sale that I've made. And then the additional entries, we would have shown the inventory leaving our stock from our shop and the equivalent cost linked to that inventory. And then it would, in essence, show us what is the profit we made on that sale. Okay, so let's just recap. Source document, it can either be paper-based or electronic. We take it to transcribe or record and summarize whatever financial information is on it into our business accounting records. Okay, so the source document is where our accounting cycle basically starts. That is where the whole process starts. The first point of origin is the source document. Then we move on to the journal. Now that is generally the next step. Now a journal we generally use, we've got 8 types of journals in accounting, and those are covered from Learning Unit 4 up to Learning Unit 8. Now, the type of journals we have those for cash transactions. We've got cash book receipts, cash book payments. So those are the cash transactions. Then we've got your debtors journal and debtors allowance journal. So that shows any sales I've made, any returns I've made. Then you've got your creditors journal, your creditors allowance journal. So that is where I've purchased something on credit or returned any of those purchases. And then I've got my general journal, which is any transaction that still needs to be recorded but isn't covered by the other ones I've mentioned so far. And then we've also got your salary and wage journals where we capture any salaries and wages that needs to be entered into our box. Okay, now the journals, the main reason for the journals is we use those to capture similar transactions in the period. So generally a period is for a month. So instead of recording 1,000 cash sale receipts in your accounting system, we rather place all the receipts in that journal. So in the cash book receipts journal, in a table. And then we total up those totals. So what we do then, at the end of the month, we take the total amount that went into the bank, and we put that into our bank general ledger account. And we take the total sales we made, and we put that to the sales general ledger account. So as opposed to putting, for example, 100 items separately into our general ledger, we put it in a journal where we then summarize or total all the individual transactions, and then we only transfer the total to our general ledger. Now, a bank reconciliation, on the other hand, that is a document where we reconcile the amount in our bank as according to our bank statement. So what does the bank say I currently have in my bank account? And then I compare it to what I have in my business books, which is my cash books. And then the difference we reconcile, and that is what a bank reconciliation does. It reconciles any items where there is, we call it a timing difference between when we captured it and when the bank captured it. And then we just reconcile to show, okay, yes, what do we have in our books versus what we have in the bank's books? Yes, it actually does balance because the following transactions have not been recorded by the bank or have not been recorded by our business just because of a cutoff issue. Okay, so bank reconciliation, you just need to know what it is. That we will focus on in your second semester. We will actually discuss how you do a bank reconciliation. Now, once you've done the journals, then you move on to your general journal or general ledger in your accounting cycle. Now, your general ledger is the bookkeeping or accounting system per se, and is a collection of accounts. So a general ledger, there is an account for each main account in your accounting business. So that means there is an account for bank, there is account for each and every type of asset, each and every type of liability, as well as your different forms of revenue and expenses. Okay, so that is what it means, a collection of accounts. But a collection of accounts, that general ledger shows a total per month. It does not show an individual transaction per month. The only way, or the only time we would actually show a separate individual amount is when we write a general journal. So that's where it didn't fit into any of the other journals for a specific transaction. For example, if discount was allowed, or we had to write off a debtor as bad debts because they can no longer pay us. Then the next item is your trial balance. Now, a trial balance is basically a list of all your general ledger accounts and their balances. So your trial balance is what we use at the end of the day to create our financial statements. Now, our financial statements is that document that management, shareholders, the investors, creditors, so the users of financial information uses to determine how a business is actually performing. But that is split into two main categories. So the first one is your statement of profit and loss and other comprehensive income, which is also known as the income statement. So this is where we show how much profit have we actually made in a year. So we show all our revenue or income less all our expenses. Where the statement of financial position, also known as your balance sheet, this is where we show all our assets, all our liabilities, and what is the equity of the business at a specific point in time. So make sure that you understand the different concepts and what they are, so that when you get to a test and they ask you for the general ledger, you give me a general ledger and not a journal, for example. Okay, so let's quickly talk about accounting cycle. So accounting cycle is basically the steps we perform as an accountant on a monthly, quarterly, annual basis. Now, as a bookkeeper, you generally perform most of these items on a monthly basis. So step one, identify the business transactions. This is where the source document is used. We identify the transactions based on our source document. Then we record those transactions in the specialized journal. So in the specific journal, whether it's a cash journal, a credit journal, those journals will make more sense when we get to those specific lending units. Then we post the totals of these journals into our general ledger. Now, the general ledger is the T account that we heard about when we were watching the video. So that is where we record our transactions on the left-hand side and the right-hand side, and it needs to balance. Okay, so in Learning Unit 2, we are going to start looking at your general ledger transactions, and then it will make more sense. Then we prepare an unadjusted trial balance. Now that is just to have a little snapshot of what is the various accounts we have, what is the balances at a specific point in time. Now as an accountant, we generally perform up to the trial balance on a monthly basis, because we will post adjusting entries, journal entries. So that is things that will not be included in our specialized journals. So that is things that happen on an ad hoc basis. We would then put an adjusting journal entry through to correct our trial balances. So that is if we've prepaid an expense, we have not received the invoice as yet, we have to accrue for interest we've received, but the bank hasn't physically paid it out in cash yet. That is what an accountant would do on a monthly basis. Then step 7, 8, and 9, that only happens at year end. So that happens when we finish off our financial period and we're closing off the books and preparing our financial records for our users. Okay, so that is basically what an accounting cycle is. And we are going to work through the entire accounting cycle in this module. From Learning Unit 1 up to Learning Unit 9, we will cover the accounting cycle. Now let's talk about the users of the accounting information. Be sure that you know the difference between the various users and why they actually prefer using the information. So let's quickly discuss the different types of users. We've got investors, so that is someone that provides capital to a specific business. So they give you money, and in exchange you will pay them dividends in the future as the business grows. Then you've got your employees and your labor union, so that is people that are employed by the business. Lenders are, for example, your banks that provide loans to a specific entity. Suppliers and trade creditors, that is where I buy my day-to-day inventory, office supplies. That is a third party that I've purchased it from. And normally with a supplier and a trade creditor, how they differ from a lender is I will have to pay off that amount within the next 30 or 60 days, depending on what the payment terms are. Creditors or trade debtors, that is the people we sell goods to or provide services to, and they owe us money, and they would generally also repay it to us within 30 or 60 days, depending on what our credit terms are. Then governments and their agencies, that is, for example, your tax authorities that would require tax. It might also be, for example, property rates and taxes. so your local municipalities, for example. The general public is more people in general out there that might be affected by this business. And then management is someone that takes part in the active day-to-day activities and the information they would require to make informed decisions. Now, from this list, do you think each of these users will have the same use out of the financial information? So will they look at the same things when they look at a business financial information? Okay, so Tatos and Dile Laseri says no, and that is absolutely correct. An investor, for example, wouldn't necessarily want to know how well the different departments are performing. They want to know, what is the return on my investment? How much money am I getting from the capital I've invested? So they would be more inclined to look, is the business making a profit? How is the financial condition of this business? Is it good or bad before I want to invest in it? Employees, on the other hand, and labor unions, they would generally look at the financial information to see, will I receive my salary? Can I expect a bonus, for example? And the labor unions will also use it to negotiate an annual increase. So based on the information, they will say, okay, well, you're making profits of this level, so we consider a 5 or 6% increase as reasonable. Lenders, on the other hand, would take the information and they would look at, is this business solvent? So that means, are their assets exceeding their liabilities? How liquid is this business? So how well can they pay their short-term creditors, for example? So that is what a bank would, for example, look at. They would also look at what assets can you potentially put up as security in the event that you fail on the loan. So based on this, you can see each and every user has a different reason why they would actually look at the financial information. Now, to ensure that we actually account for the information correctly so that these different users can use it, we call it qualitative characteristics. Let me just see if that's on here. Okay, let me just quickly explain it before we do the activity. So we've got qualitative characteristics that sets out basic requirements for each set of financial statements to make sure that they look the same from one company to the next, so that different users get the information they need in order to make an informed decision. Okay, so the next thing I want us to do, in your text box on page 6, question 1.1, for the guys that don't have it, I'm going to read it. The question is on the screen, however, of what we need to answer. There are clearly numerous advantages and benefits of using financial information. However, there are also distinct limitations. Now, what I want you to do is pop onto the internet and go look at what type of limitations does financial accounting information have. So we're going to take 5 to 10 minutes to do this activity. I'm going to stop the recording, and then once we, after 5 minutes, we can then discuss it and see what you guys came up with. So just to repeat, I want you guys to go onto the internet and see what are some of the limitations of financial accounting information.